Welcome back. Our research team is standing by to help you with the list of top 10 stocks. First up, we have TCS that we're looking at. Reema's here to give us the lowdown. Reema, morning.
Hi, thanks so much for that. So TCS announced yesterday that they've expanded their partnership with one of UK's largest insurer, Aviva, for 15 years. So Aviva and TCS have had a long-standing partnership which spans close to about 2 decades, and this partnership has been extended for another 15 years. Now, according to Mint report, the size of this deal could be $2.5 billion, which is spread over the next 15 years. We've not independently verified it, but it could be a potentially very large deal. That's what the reports seem to suggest. So it's good news for TCS as it bags a big deal, which will boost the UK revenues for the company. Back to you.
Okay, all right. Thanks a lot for that, Reema. Well, Vivek joins us to tell us about L&T. Vivek, the numbers a little bit subdued, but the orders, the commentary on that was pretty good.
Well, absolutely right. A mixed bag. And what's actually been happening as far as L&T is concerned is that, and this story is repeating for the past several quarters, number one, operationally it's been quite subdued. Execution is good, but operationally, because of the fact that the company is continuing to go ahead and execute on legacy orders, which were lower margin orders, this is something that's going ahead and impacting the core P&M, margin. But order inflow, number one, the guidance as well as the order inflows that the company is receiving, especially in the hydrocarbon segment from the Middle East, is something that remains quite strong. Let's take a look at the numbers. Number one, revenues much above the CNBC-TV18 poll on the back of strong execution. But the margins coming in at 10.5% versus our poll of around 11% is a significant miss, and this continues to remain a disappointment. Profitability on the back of that was below our poll. But what are the key highlights? We attended the media call yesterday that L&T held. Number one, the company is likely to end FY24 with an order inflow growth of over 20%, and the earlier guidance was just around 12%. Largely expected, but still, it's a significant beat to what the company itself was expecting at the start of FY24. Along with that, when you're talking about the revenues, the company is expected to end FY24 with high-teen revenue growth. What they had guided for was 12 to 15% growth, so likely to go ahead and beat even that. But the core EBITDA margin guidance, they started the year with 9%, then they trimmed it to 8.5% to 9%. Now there's been a further trimming down of that. 8.25 to 8.5% is what the company is expecting. So on the back of that, expect some weakness in L&T today, given the fact that the stock has run up quite significantly.
Okay, well, Vivek, thank you very much for that. Coming back to you for more in a bit, but Dr. Reddy's was the other big number which came out. Ekta's got details on this one. Ekta, hi, morning.
Morning. Well, very interesting set of numbers because, when Dr. Reddy's reported their numbers, there was nothing wrong with it. Extremely strong beat for Dr. Reddy's in the previous quarter. Revenue up around 7%. Street was anticipating a 2% growth. EBITDA has come in at over 2,100 odd crores, which is better than expectations. Margins 29.3%, better than expectations, and profit as well. Now, the main reason for the beat was the US sales. US sales came in at over $400 million versus $382 million Q-on-Q and versus $355 million in terms of an estimate. So that's the kind of alpha they reported in terms of the US sales. India, strong market for them, but it was subdued. It was up only around 5% in terms of growth. The reason why I expect Dr. Reddy's to be in the red is because brokerages are subdued. CLSA has downgraded the stock to underperform from buy. Citi has a sell with a target price of 5290. Antique has maintained its sell rating on the stock as well.
All right, thanks a lot for that. So Street is divided on Dr. Reddy's performance. Let's see which way it goes. But M&M Financial could be under some pressure today. Abhishek is here to tell us why. Abhishek, over to you.
Well, Sonia, the numbers were good. However, the management has tweaked the guidance, which may keep the stock under pressure, as you mentioned. So, the guidance that management has tweaked is that the ROA was initially targeted at 2.5% in FY25. Now, management says that it is difficult to achieve this ROA, given the fact that they expect the net interest margin to be on the weaker side. So, NIM can be softer than the earlier estimate that the management had. Drivers for ROA would be other income and lower credit cost or lower provisions for NPAs. They have also tweaked, ECL assumptions, that is expected credit loss, or as we call it in normal language as provisions for NPAs, that has been tweaked. So for secured products, they have tweaked it in terms of giving it a go. Estimate tweaked for provisions lowered by 86.1 crore for secured products, which has helped the earnings this time around. So Q3 FY24 net interest margin has expanded sequentially by 30 basis points. point. Asset quality continues to improve, so gross NPA ratio is perhaps one of the lowest that you are seeing in last 34 to 36 quarters. AUM growth is healthy at 17.8% YOY and 2.5% sequentially. Take it with a pinch of salt that the tenures are increasing, and that is why you are seeing lower repayments and higher AUM growth. In terms of the performance, both in PNL, the NI and PAT is ahead of our poll. Back to you.
Okay, all right, Abhishek, thanks for that. And the management of Mahindra Financial will be joining in at 10:10 a.m. today on Bazaar. Well, let's get back to another couple of results. Sonal tells us about SRF. Sonal, how are the numbers?
Well, the numbers are weak, lower than what the CNBC-TV18 poll suggested. The revenues were down 12% on a YY basis, lower than the poll at 3184 crore rupees. EBITDA was down 32%. Margins, they declined almost 600 basis points, and it was lower than the poll of 19.6%, came in at 18.5%. Net profit was down 50% on a YY basis. It was led by the chemicals and packaging segment. However, in their commentary, the management indicated that yes, this was a weak quarter and it was substantially impacted by the weakness seen in chemical segment because of inventory destocking and other reasons. But going forward, they expect improvement in the chemical segment. In fact, they're saying they are expecting significant improvement in performance from Q4. The conference call is at 3 p.m. today. We'll get more idea of their commentary. But yes, positive commentary, but weak numbers from SRF. All right, thanks a lot for that. Upasana is with us to talk about a couple of numbers. There's Voltas, Cochin Shipyard, KEC. Upasana, what stands out for you?
Well, first up is Voltas. The company reported a weak quarter this time around, and the stress is mainly coming from the international business side in the electromechanical project segment. Well, coming to the revenues, they were above our estimates, while PAT and EBITDA were below the poll numbers. Revenue saw an uptick of almost 31% on YY basis. Margins stood at 1.1% versus 4%, while we were working with a poll number of 4.05%. Coming to the unitary cooling product segment, the revenue saw an uptick of 21% and margins also sharply expanded by 100 basis points to 8%. While the growth momentum continued in this segment and volumes also grew by almost 22% on YY basis. Coming to electromechanical projects, on the international business, a few projects, especially in Qatar, are still under stress due to delays leading to cost overrun and resulting in a loss of almost 143 crores in the current quarter. Next is Cochin Shipyard. The company has reported a strong results. The revenue saw an uptick of almost 64% on YY basis. EBITDA stood at 310 with an uptick of almost 109% on YY basis, and margins also sharply expanded from 23% to 29%. PAT also saw an uptick and saw a growth of almost 1.2x times and stood at around 244 crores. Next up is KEC International. The company also reported a good quarter with a revenue uptick of almost 14%. The margins also sharply expanded from 4.6% to 6.2%, and YTT order book plus L1 position of the company stands over 38,000 crores.
Okay, Upasana, thanks very much for that. Well, let's move on and talk about the insurance space. PB Fintech reported numbers, and so did Star Health. Yash is standing by with details on both. Yash, morning.
Well, good morning, Prashant. So, of course, PB Fintech, the numbers looked quite good for the third quarter. Of course, the highlight for the company was that they spoke about the first quarter of profitability, consolidated profitability on new business and the core business as coming in the third quarter. As far as the revenue is concerned, the total revenue that grew by 43%, under which the core business revenue was up 40%, the new initiatives revenue was up 50%. Contribution was up 61%. The contribution margin was higher by 400 basis points in the quarter. Adjusted EBITDA profit, that came in at 39 crore versus loss of 28 crore. The adjusted EBITDA margin came at 4% versus negative margin of 5%. And finally, as I spoke about the first quarter of profitability, profit after tax at 37 crore versus loss of about 87 crore. For Star Health Insurance, the numbers looked weak. Net earned premium grew at 15% on a year-on-year basis. Compare this to the industry growth. The average standalone health insurance industry has grown upwards of 25%. So this was subpar growth as far as industry comparison is concerned. Underwriting profits were down 9%. Underwriting, your combined ratio came in at about 97.83% as compared to 94.81% on a year-on-year basis and 99.22% on a quarter-on-quarter basis. One important point to note under Star Health is that the incurred but not reported claims, the IBNR claims, seem to have gone up significantly. Retail health claims were up 32% and group health claims, they were up about 15%.
All right, thanks a lot for that. Well, lots of numbers coming through, so let's help you do a quick recap. Stocks with positive news flow, there's TCS, M&M Financial, well, I'm not too sure because the company has, of course, scaled down their own guidance, so maybe pressure there. PB Fintech, Cochin Shipyard and KEC International, while stocks with negative news flow, L&T, Dr. Reddy's, SRF, Star Health and Voltas. But Brent crude prices have also been inching higher to about $84 a barrel. The last time I checked, Manisha Gupta joins in for a roundup of all the action there. Manisha, good morning.
Morning, Sonia, and thank you for that. Well, the crude oil prices have been quite volatile. We did see 1.5% of gains in the overnight markets for crude. This is on the back of higher global economic growth forecast by IMF. There are escalating tensions in the Middle East. The U.S. also has reimposed sanctions on Venezuela, and you also are looking at the U.S. crude stocks declining by 2.5 million barrels. The street will now watch out for the FOMC meeting announcement today, and it is the OPEC and allies meeting on 1st of Feb. So these two events will keep the markets quite jittery.
Okay, Manisha, thanks a lot for that. So a couple of events that are going to keep the markets jittery, but